Okay, so let's talk about Home Depot because there's a really fascinating puzzle playing out right now. On one hand, you've got all these negative headlines swirling around, but if you dig just a little deeper, you'll find a completely different story, one that's a whole lot more optimistic. Right? I mean, all the news you hear is pretty gloomy. So the big question is, why on earth would someone, and we're talking an investor with very deep pockets, suddenly make this massive bet on the company? It's the complete opposite of what you'd expect. So let's do what the pros do. Let's follow the money and see what's really going on here. And this slide really lays out the two completely different stories. You've got the public story, disappointing earnings, they lowered their guidance, and the stock is hovering near its 52-week lows. Not great. But then there's this hidden bet. We're seeing massive institutional buying, these really high conviction call options, basically a huge wager on a sharp reversal. So what in the world did they know that maybe the rest of us don't? All right, section 1, the whale's footprint. We're going to start by uncovering the first major clue in this whole thing. So here's our first clue, and it's a big one. We're seeing a huge wave of really aggressive call option buying. Now, this isn't someone just buying shares of Home Depot. A call option is basically a bet that the stock's price is going to go up. But what's super interesting here isn't just that they bought calls, it's the specific kind of call option they chose. They bought something called an in-the-money call option. Okay, so what does that even mean? Well, think of it like this. You could buy a cheap out-of-the-money lottery ticket hoping for a 1 in a million shot. Or you could buy a much more expensive ticket that's already a small winner and has a much better chance of becoming a big winner. That's what an in-the-money call is. It costs way more upfront, and that tells you something. It signals a ton of confidence in the trade. And when I say it costs more, I mean it. We're talking over $1,500 for a single contract. So when you see this kind of money and this specific structure being used, you know it's not some random gamble. Nope, this is a calculated, strategic move by a big institution that's basically screaming, we think this stock is undervalued and it's about to pop. Okay, so clue number 2, the sentiment shift. Now, this is where things get a little counterintuitive, maybe even a bit weird. The whole idea here is that all the bad news we've been hearing might actually be good news. Yeah, I know how that sounds, but stick with me. The theory revolves around a concept called seller exhaustion, and it's actually pretty simple when you think about it. It's the idea that at some point, everybody who was panicking, everybody who wanted to sell, well, they've already sold. There's just no one left to hit the sell button. So think about how this usually plays out. Step 1, the bad news drops. Home Depot misses earnings, lowers guidance. Step 2, people react, right? They sell the stock and the price gets pushed down, down, down towards those 52-week lows. But then, and this is the key, step 3 happens. The stock just stops falling. Even with all that negativity, it hits a floor and halts. That's the sign. That's when you know all the potential sellers are likely gone. It's a classic sign of what traders call capitulation. Basically, the worst is out, everyone knows it, and it's already baked into the stock price. And it really comes down to that old trading adage. When a stock stops going down on bad news, it often indicates that all the sellers have already sold. It means the market might finally be ready to look ahead. All right, section 3, signals from the chart. So we've got the whale's bet, we've got the sentiment theory. Now let's look at the chart itself and read the technical tea leaves. So one of the big tools traders use here is called the Relative Strength Index, or RSI for short. Just think of it like a momentum meter for a stock. And there's this magic number, 30. When the RSI dips below 30, it's basically a big flashing sign that says oversold. Now, for a solid blue chip company like Home Depot, seeing that signal is often a huge hint that a bounce might be just around the corner. But hey, it's not just the RSI. There's a whole bunch of other things that seem to be lining up perfectly. First, you've got this key support zone. The stock has found a ton of buyers every time it's dipped into that $330 to $340 range. It's like a safety net. Then there's something called a gap fill potential up near 360, which trading algorithms just love to target. And you can't forget about the time of year. You've got the holiday season coming up, a potential Q4 boost, plus this funny thing called window dressing, where big funds will buy up beaten down stocks like this right before the end of the year to make their holdings look better. All these things are pointing in the same direction. Okay, section 4, breaking down the bet. So we've got all the clues, we've got the context. Now let's actually crunch the numbers and see what this move is all about. So let's break this down nice and simple. The strike price on the option is $345. The investor paid about $15 for that option. You just add those two together, and boom, you get your break-even price, $360. That's the magic number. The stock has to get above 360 for this whale to even start making a profit. And check out the delta. That 0.65 means for every $1 Home Depot stock climbs, the value of their option goes up by about $65. Pretty powerful stuff. So really, when you strip away all the jargon, it's a surprisingly simple bet. This wheel is putting down a ton of money on the idea that Home Depot is going to rally just 3 to 4%. Just enough to get past that $360 break-even point before the end of the year. That's it. All right, let's put it all together. The final thesis. We've looked at the money, the mood, and the math. Let's combine all those clues. So here it is, the whole thesis in a nutshell. We have a whale, a big-time investor, who is completely fading the negative public sentiment. They're betting against the crowd. They see all the bad news, but they're concluding that the selling pressure is finally tapped out. They're betting that this combination of seller exhaustion and solid technical support means a short-term relief rally isn't just possible, it's overdue. So there you have it. The whale has placed its bet. It's a classic contrarian move, a huge bet that pretty much everyone else is wrong. The question now is, will the market prove them right?